Let's talk about financial contracts, options. Now, before you think that this might just be another Wall Street Bet crazy video, let me just tell you that financial contracts, their market, is orders of magnitude bigger than the equity market itself, which is the underlying market. Also, you should know that there are big financial institutions, hedge funds, they use this instrument every day in order to create leverage or protect a portfolio in a process called hedging. You might have heard about this. And they do make money. So if your perception of these option contracts is that they are just too risky or they just represent a quick way to lose money, it might just be that you are using them incorrectly. So let's learn the proper way to use them. All right. To get started, you should know that there are two types of financial contracts: calls and puts. And because you can buy them and sell them, you can basically create a quadrant. Something that looks like this. You have calls and puts, and you can buy them and sell them. Now, when you try to learn about these financial contracts, you might be tempted to look into their definitions, and that's fine. But if you're just a beginner, their definitions might be a little bit confusing, to say the least. It might just throw you off. You can find definitions everywhere. You can find definitions in a book like this. For example, an auction call is defined as a right to buy or take a long position in an asset at a fixed price on or before a specified date. All right, so if you're not familiar with all those terms, that might just be a little bit confusing. So my advice to you will be to focus on the application rather than the definition, just to get started. So with that, going back to this quadrant, all of these financial contracts might be viewed as something else based on their applications. For example, buying a call may be viewed as leverage. Buying a put may be viewed as insurance. Buying or selling a call may be viewed as bonus, and selling a put may be viewed as a discount. Now, we're gonna get more deeply into all of these financial instruments, but for now, just talking about them in general terms. When you buy a call, that represents a leverage because, you see, you will do this when you feel bullish about stock. You know the company, there is an earnings call coming, you feel good about the future of the company. So normally what you will do is to go and buy the stock. Well, you can also buy the call, and if your trend is correct, if the stock goes up, then most likely the call auction will increase in value as well, giving you a larger gain in terms of percentage. Now, that is buying a call. When you buy a put, that is insurance. That is the opposite of buying a call. You will do that when you feel bearish about a position. Say, for example, you own the position and there are not good news coming in an earnings call. You feel that the stock might drop in price a lot. So what you do is you buy a put in order to protect that position. And that is literally buying insurance. When you sell a call, it will be in a situation where you have the position and you decided to exit the position. Say you have reached your exit point, your exit price, but instead of just selling the position, you basically sell it at a premium, for a premium, and when the transaction is settled, you get a bonus. It's like getting an improved price on the selling of that position, if you will. And lastly, we have selling a put. That is viewed as a discount. So even though we are selling something, it means that we are buying a position, but we get it at a much lower price. So that would be in the case where you want to start a position in your portfolio. You are set on a stock and you want to buy it, hold it for the long term. But instead of just going and outright buying the position, you basically do it through a put. And with that, you get essentially a discount. Okay. So, like I said, we're gonna talk about all of these financial contracts in future videos. For now, my advice to you, especially if you're just getting started with all of this, will be to stay away from the buying side. You see, you want to buy a call or a put whenever you have information about stock. And I'm not talking about the type of information that you will get on a financial newspaper or a financial website, for example. By the way, if you ever trade on the news, you have to know that the price is already set. The news is already pricing the stock. The type of information that I'm talking about is the type that you will get when you do deep research on a stock, for example. I'm talking about researching in financial reports, listening to past financial earnings, knowing the management of the company, knowing the strategy for the future of the company. That's the type of information that you want to benefit from when you're either buying a call or buying a put. For the most part, like I said, I think that is better to stick to the sell side. And that had been my strategy. That had been my investment philosophy. And that is what had worked for me so far. And that is what I want to share with you in future videos. All right, for now, thank you so much for listening. And I will see you on the next one.